Do you want a cheat sheet to be able to create wealth out of equities or share market investing? Well, watch this video carefully.
Dangerous not in the way of harmful to others, but being the type of person that can't be harmed, person that can't be messed with.
A few years ago, I started to ask myself, as somebody who has a passion for the type of education that is going to empower people, what do I stand for? And I realized I'm not here just to make people happy, or just to teach them about kindness, or just to teach them about how to have peace. I'm not saying that those things aren't important, but I kind of realized that the most important thing that a human being is really going to need to thrive in the real world, which can be very harsh at times, is the ability to be powerful and dangerous. Now, I've been talking about becoming powerful for quite some time, but I've added the word dangerous in it. And sometimes when I talk about being dangerous, people say, well, why do I need to be dangerous? Becoming dangerous is not about being harmful. It is actually about the type of person who cannot be harmed, who cannot be messed with. Because here is what I have realized. When the shit hits the fan, meaning when you're going through an economic crisis, a health crisis, a relationship crisis, or a career crisis, let me tell you, your humility is not going to help you, your kindness is not going to help you, none of the stuff that you have learned from other places is going to help you. The only thing that is going to allow you to be able to conquer your challenges is power and strength. And that's what being powerful and being dangerous is all about. Now, how does that relate to equities investing? Well, if you have wealth and you understand how to create wealth, it definitely gives you more choices and options in life. Having more wealth makes you stronger because you are able to buy resources to fulfill your objectives. Not only that, it is difficult to mess with a person who is financially well equipped. So let's talk about how you can create wealth out of equities by not making the mistakes that the majority of people in the world will make when they do invest in equities or the share market. Now, you need to understand that the share market is an incredibly efficient vehicle for people to create wealth if they understand and implement some basic fundamentals. In the vast majority of the world, if you are living in a developed country or a developing country, if you go back and look at your major stock market index, which is simply a collection or a basket of all the companies that are trading on your stock market, you will find that over the last 10, 20, 30, 40, 50 years, the stock market index continues to go up, 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 which is simply an indication of the fact that companies produce valuable products and services, and because of those products and services, they are able to continue to trade. And because companies are rational entities, for the most part, they have to work out how to create products and services that the market wants, how to distribute those products and services at a profit. And as those companies make a profit, if you own the shares of those companies, you actually benefit from that growth. So reality is that if most people had invested properly in the equities market in a developed country or a developing country, and they had done that, or their parents or grandparents had done that, most people would be sitting on an incredible amount of wealth. But the fact is that the majority of people are not wealthy in the world. Over 90% are not wealthy and are not going to be wealthy because they don't understand the fundamentals. So let's talk about how you can create a dangerous and powerful financial plan through equities investing. Now, before I go into the steps, I must make you understand that when I'm talking to you, I'm just giving you general guidance and education. In order to assess whether what I'm saying fits in with your current situation, your goals, your risk tolerance, and your time frame, it is best to always also seek the advice of a professional like a CPA, a CFA, or a CA that can guide you about the appropriateness of what I'm saying for your circumstances. Let's get into it. The first thing is, if you really want to create wealth out of an equities or a share plan, you must diversify. Now, I know that people have heard about diversification, but majority of people don't actually really understand what diversification is. Most people who lose money on the stock market are people who've actually got a lot of concentration in one or two companies, or one or two industries, or 1, 2, or 3 countries, and so on and so forth. That is how you increase the odds of you losing money. But let's just say you had found a way that you could invest in 1,000 companies. And those companies, 1,000 companies, were diversified not just at the industry level, meaning that you had some exposure to mining, some exposure to tech, retail, banking, whatever it is. But you also had exposure at a geographical level. So you did not have too much concentration in any one or two countries, because that concentration in a geographical location also increases your risk because of political reasons. If there is a country is going through any political issues, then that can impact the stock market, and that can impact your equities portfolio. So if you diversify at the industry level, you also diversify at the geographical level, but then you go further and you diversify at the size level, meaning that you have good concentration in large companies and mid-sized companies and in small businesses. Now you have incredible exposure. But not only that, let's just say you decide to invest in the equities market through fund managers. You can now also diversify at the fund manager level, where you can have multiple fund managers managing your money. Now, there is an art to diversification. You don't want to spread yourself so thin that you never get a good return, but at the same time, you don't want to be so concentrated where you can lose your money. So if you diversify properly, it actually assures that you are not going to lose money, because you cannot have 1,000 or 2,000 companies all go bankrupt at the same time. Even if you have a company where they have manipulated the books or the accounting, or they have either involved in any type of scandal and that company ends up losing money, well, if you only have a small exposure to that company, you cannot lose your entire wealth. So that's why diversification properly ensures that you will continue to create wealth, because in a capitalist economy, companies have to continue to improve their profitability and revenue over a period of time. The next way that you can create and boost your wealth through the share market or by holding an equities portfolio is through what we call a systematic investment plan, or dollar cost averaging as it's called in the Western world. And what that simply means is you are choosing to nominate an amount that goes into your portfolio every month or every week or every quarter at regular intervals. The wonderful thing about this is when the stock markets go up in value, they're more expensive. Think about it, right? When you're buying a commodity and the price goes up, it's more expensive. So what happens is when the stock market goes up, the money that you're allocating into the portfolio automatically buys less. But when the stock market goes down, you automatically buy more. So one of the things about a dollar cost averaging plan or a systematic investment plan is that you are being incredibly efficient. You're not timing the market. You're automatically buying less when the markets are expensive, and you're buying more when the markets are cheap, which allows you to be able to accumulate more and more stocks in your portfolio as time goes. The next thing that you can do to boost your wealth out of your share or equities portfolio is to have majority of your money in a fund that does not attempt to outperform the market. Because any fund manager that is continually working on outperforming the market, it's also called active management. So any fund manager that's involved in active management has to buy and sell frequently. Not only that, they have to also continue to watch the market, which means they have a research team, they have somebody who's sitting there with skills who is doing this work for you. The thing though is when you use active management for the bulk of your portfolio, what ends up happening is you end up paying a lot more fee. And that fee is not necessarily dependent on performance. You have to pay that fee even if your portfolio doesn't perform. So one of the ways that you can boost your wealth by investing in a stock market or equities portfolio is to keep your costs low. If majority of your portfolio is held through an index fund or an index exchange traded fund, what ends up happening is your costs are very low because your fund manager is not continually involved in buying and selling decisions or research decisions. You simply buy the entire index. And so because of the less buying and selling, there is less tax generated in the fund, and that means better returns can be passed to you over the long period of time. Also, there is not enough research to suggest that active managers actually outperform index managers over a period of time. Research is very clear that the vast majority of active managers do not outperform index fund managers who are simply trying to replicate the index and making no attempt to outperform the index. And so what happens is, if you're giving your money to an active fund manager, you may find that most of the time you have to pay that excess fee, which erodes your net return, but may not necessarily give you the benefit that you were hoping for. The next thing that you can do to maximize the probability of achieving a positive return out of your equities portfolio or creating wealth out of your stock market portfolio is to not trade or time. Minimize trading activities. Every time you do a trade, you're paying brokerage, but you're also paying taxes, because if your stock has gone up in value, that's essentially a capital gains, and that capital gains you have to pay tax on. But not only that, you're trying to time the market, and the markets are incredibly efficient. Most people time the market based on what they hear from news, but by the time it's made the news, it's already old news. The fact is that most of the valuations of the stock market are already factored in the stock price. So it's very rare that you'll get an individual who is so skilled that can continue to outperform the stock market. But the question is, there is no need to outperform the stock market. You can actually become really wealthy just by capturing the full return, whereas a lot of people want to, for some reason, outperform the stock market. And you have to understand that outperformance of the stock market is not a financial goal. I have never had a financial goal to outperform the stock market. I simply have a goal to achieve a level of wealth, which means that I never have to worry about money for as long as I'm working and when I stop working. Now that's a meaningful goal, but trying to outperform the stock market is an ego-based goal. It has no meaning or relevance. So give up that goal, give up the need to time and trade the market, and you just try and capture the market return, and that you'll find that over a period of time, you're going to become wealthier than those who think they have the capability to time the market or to be able to trade consistently with success. The only time that you should try and reduce exposure to the stock market is if you're absolutely certain that there is a bubble building. Now, this is also very difficult to implement because you can't really trust the media to tell you when the bubble is building. So many times the media has got it wrong. So many times the media said the market's about to crash, people pull out, and then over a period of time the market ends up going up, and then people get back in when the market's going up, and now they're buying everything more expensive. So if you are absolutely certain, you can absolutely verify 100% without any doubt that there is a bubble building in the market, that might be the only time that you want to reduce your stock market exposure. Now, let me be very clear. This is very, very hard to predict beforehand. So you have to be very careful that you make this decision right. But I personally would not even do that. I personally remain invested regardless of the ups and downs, because I'm convinced that in majority of the economies, even when the stock markets correct or they crash, 75% of the times they tend to be up and 25% times they tend to be down. So even if I'm constantly going down, it's not a problem because most of the time I'm going to go up. In fact, if I have a long time frame to invest, I actually don't want the markets to go up a lot, especially if I'm dollar cost averaging or have a systematic investment plan. The reason is very simple. I want to buy things cheap. I want to buy stocks cheap. So I can only buy stocks cheap when the markets are down. I can't buy them cheap if the markets are up. Since I'm not going to need to rely on this stock portfolio for a period of time because of my age and the time frame that I have, I actually want the markets to be more down than up. Now, fortunately or unfortunately, the markets are up more time than they're down, but I want those downs to happen so that I can continue to buy more and create more returns in my portfolio. So please understand that you really want to nail this concept. You want to understand that you create more efficiency by buying when the markets are buying more when the markets are low and buying less when the markets are high. The next thing that you really need to do if you want to create an incredible amount of wealth through equities and stock market investing is not to panic when the markets correct or crash. Don't panic. It will happen. It's guaranteed to happen. It's absolutely inevitable that the markets are going to correct. Once or twice, every 1 or 2 years, they're going to crash, probably every 4, 5, 6, 7 years. And so don't be afraid of when that happens. When that happens, just understand that that's the price that you have paid. You have the price that you pay to make a superior return from the stock market is to withstand the volatility that is inherent in the stock market. That is the price you're paying. The reason you get a high return on the stock market over the long term is because of the inherent volatility. That is what people can't, they can't stand it, they can't accept it. And that's why they don't get the returns of the stock market, because they continue to pull the money out. So understand that market crashes and corrections are very normal, and the price that you're paying to get a superior return than any other asset class over the long term is to embrace that volatility that comes with investing in the stock market. The next thing that you can do if you want to create inevitable wealth out of the stock market and you want to boost your returns is to understand that the news is not interested in you building wealth. Newspapers are simply interested in selling the news, and they cannot sell the news until they're sensationalized and they have some negativity around global events, because negativity sells because it appeals to the primitive human mind. Please understand that the majority of journalists are not financially educated, and the majority of journalists are not wealthy themselves. They don't have the investor mindset. They're not interested in you building wealth. So they're going to come up with things like, look at the top 5 portfolios, look at what's about to happen, and a lot of the news is going to be negative. They're going to talk about the oil prices, or they're going to talk about the war here or there, and what they're really trying to do is sell the news. Do not buy into the news, and make sure that you continue to invest, because the only realism when it comes to the stock market is to understand that the stock markets have always gone up. It's actually unrealistic to be fearful of the stock market, because in the long term, majority of indexes have never gone backwards over a 10 or 15-year time frame. The next thing that you want to do to become really good at creating wealth out of a stock market portfolio is to understand that you actually invested in real companies. And companies are the most rational things in the world. The market is the most irrational thing in the world. It doesn't really matter what the markets are doing. What really matters is what the companies are doing. And every time the markets crash, you need to have a bit of a perspective change. And instead of saying, I've lost money, realize you haven't lost anything until you sell. So when you see a temporary decline in your stock market portfolio, or you see a negative return on your statement, it doesn't mean you have lost money. So only invest the money that you're not going to need for at least 7 to 10 years. And when you see a temporary decline, understand that you have lost nothing as long as the companies are still trading. The only time you crystallize your loss on paper is by selling. So avoid selling unless your goals and objectives have changed. The only time you sell stocks are if your goals and objectives have changed. If you have a diversified portfolio of quality companies, there is really no other reason to be selling your stocks when the markets decline. Lastly, understand that the majority of your returns are not going to come from the stocks that you have picked. It's not going to come from the way your assets are allocated. It is not going to come from how you time the market. The majority of your return is going to come from how you manage yourself. There's a big difference in what the stock markets return and what the stock market investors achieve. If you actually look at research, and there's a very prominent research called the Dalbar report, and it's looked at a number of periods, 20-year periods, where they found a significant difference between what the stock market achieves and what stock market investors achieve. And there's a tremendous difference. The vast majority of investors never truly capture the superior and positive returns of the stock market, not because of the markets, but because of their own behaviors. And the two behaviors that you really need to manage are your tendency to succumb to greed or the tendency to succumb to fear. These two are very powerful emotions. Greed and fear will destroy your portfolio more than market crashes and corrections. So build emotional resilience, build a long-term perspective, remain focused on your goals, ignore mass opinion and media, and make sure that you understand that your stock portfolio is not going to be destroyed by the markets if you do all the things that I have mentioned, but it's going to be destroyed by you if you succumb to fear and greed. I hope you've enjoyed some of the tips that I have shared about becoming a successful stock market investor. Remember, this is about becoming powerful and dangerous in your life, the type of person who cannot be messed with. And financial resources is one avenue through which you actually build that dominance and authority in the world. I wish you all the best.